Ever wonder how you could invest in the entire stock market or a specific sector with one simple move? Welcome to the world of index funds, a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a market index. They offer a way to invest in the broad market or specific sectors without having to buy each individual stock or bond. Index funds have gained popularity among investors for their diversification benefits, low fees, and potential for steady long-term growth. Diversification minimizes risk by spreading investments across a wide range of companies or sectors. Low fees mean more of your money goes towards your investment, not the fund manager's pocket. And the potential for steady long-term growth makes index funds a suitable choice for those looking to grow their wealth over time, rather than chasing quick wins. So if you're interested in an easy way to invest in a broad market or sector, index funds might just be what you're looking for. Now that you have an idea of what index funds are, let's dive into some of the most popular ones. First up is the Vanguard Total Stock Market Index Fund, also known as VTSMX. This fund is like a snapshot of the entire US stock market, aiming to replicate the performance of the CRSP US Total Market Index. It's popular because it offers investors exposure to a broad range of companies, from the biggest blue chips to the smallest startups. It's a one-stop shop for those looking to invest in the US equity market. Next, we have the Fidelity 500 Index Fund, or FXAI. This fund tracks the S&P 500 index, which consists of 500 of the largest US companies. Investors often turn to this fund for its simplicity and its exposure to some of the most influential corporations in the United States. It's a straightforward way to invest in the US large-cap equity market. Then there's the iShares Russell 2000 ETF, symbol IWM. This fund focuses on small-cap stocks, specifically those in the Russell 2000 index. It's a popular choice for investors looking for potential growth and a way to diversify their portfolios beyond large-cap stocks. But it's worth noting that small-cap stocks can be more volatile than their larger counterparts. The fourth on our list is the Schwab US Broad Market ETF, or SCHB. This fund aims to track the performance of the Dow Jones US Broad Stock Market Index. It's another great option for investors seeking broad exposure to the US equity market, encompassing both large and small companies. Moving on to bonds, we have the Vanguard Total Bond Market ETF, known as BND. This fund provides exposure to a wide range of US bonds, including government, corporate, and international dollar-denominated bonds. It's a popular choice for those seeking income and diversification from equities. Next is the iShares MSCI EAFE ETF, symbol EFA. This fund focuses on large and mid-sized companies in developed markets outside of North America, including Europe, Australia, and the Far East. It's an excellent choice for those looking to diversify their portfolio internationally. The seventh fund on our list is the Vanguard Emerging Markets Stock Index Fund, or VMAX. This fund targets stocks from emerging markets like China, India, Brazil, and others. It's a popular choice for those seeking potentially higher growth and willing to accept the additional risk that comes with investing in emerging markets. Following that, we have the Invesco QQQ Trust, symbol QQQ. This fund tracks the Nasdaq 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the Nasdaq stock market. It's a popular choice for those looking for exposure to innovative and tech-heavy companies. Second to last is the SPDR S&P Dividend ETF, known as SDY. This fund tracks the S&P High Yield Dividend Aristocrats Index, which consists of companies that have consistently increased their dividends for at least 20 years. It's a popular choice for income-focused investors seeking dividend-paying stocks. And finally, we have the Vanguard Real Estate ETF, or VNQ. This fund provides exposure to US real estate investment trusts, commonly known as REITs. It's a popular choice for investors seeking income and a way to diversify their portfolios outside of traditional stocks and bonds. Remember, the popularity of an index fund doesn't guarantee its future performance. It's important to do your research and consider your financial goals. Choosing an index fund isn't just about picking the most popular one. There are several factors you should consider. First and foremost, consider the fund's expense ratio. In essence, this is what it costs you to invest in the fund. It's the annual fee that all funds or exchange-traded funds charge their shareholders. It represents a percentage of your investment and is used to cover the fund's annual operating expenses. The lower the expense ratio, the better. Lower expenses mean more of your money is working for you rather than going to the fund manager. Next, consider the fund's tracking error. This is the difference between the fund's performance and the index it's tracking. A low tracking error means the fund is closely following its index. A high tracking error may indicate that the fund is straying from its index and could be a red flag. Another factor to consider is the fund's size. Large funds have been around for a while and have proved they can manage their investments effectively. Smaller funds might offer the potential for higher returns, but they might also carry more risk. Additionally, consider whether the index fund fits with your overall investment strategy. If you're a conservative investor, for example, you might opt for an index fund that tracks a broad, stable market index. If you're more adventurous, you might choose a fund that tracks an emerging market or sector-specific index. Finally, consider your risk tolerance. Higher risk index funds may offer the potential for higher returns, but they can also lead to bigger losses. Lower risk funds may not offer as high a return, but they can offer more stability. It's essential to balance potential returns against potential risk and to ensure you're comfortable with the level of risk you're taking on. Remember, investing in index funds should be a strategic decision based on careful research and consideration. Choosing the right index fund for you is an individual decision that should align with your financial goals and risk tolerance. So, we've covered quite a bit about index funds today. We've started by understanding what index funds are, a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. They provide broad market exposure, low operating expenses, and low portfolio turnover. We then moved on to explore some of the historically popular index funds, including Vanguard's Total Stock Market Index Fund, Fidelity's 500 Index Fund, and iShares Russell 2000 ETF, among others. These have been recognized for their performance, but it's important to note that their popularity and performance can vary. Finally, we discussed the key factors to consider when choosing an index fund. This includes understanding your financial goals, the fund's performance history, its expense ratio, and its alignment with your investment strategy. Remember, investing should never be a hasty decision. Always do your research, consider your financial goals, and if needed, consult with a financial advisor. Happy investing!